Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup. This is for the trading week ending April 16th, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme, a market head scratcher. Before we get into that, let's just kind of take a look at where we were from this past Friday's close, and then we'll talk a little bit about where I think we can go from here. So if we look at the index performance and just take a look at the U.S. markets, you can see everything. There's a lot of green here on this screen. Dow, S&P, NASDAQ, Russell, everybody in the green. Year to date, the S&P is just about caught up to the Dow. The Russell is still leading the way at 14.58. NASDAQ's made a pretty good little run recently. It's up to 9.03%. See the PE ratio? The forward 12-month is still fairly rich at 23.49. The spread between the 10-year and the S&P dividend yield is 15 basis points, so you make an extra 15 basis points by holding a risk-free investment, which is why you still got money pouring into the S&P. Okay. The VIX also down just a little bit for the week again, so we've had 2 weeks in a row where the VIX is closed a little bit lower. We're at 16.25 rather for the week where we closed. The sector performance for the week, everybody was in the green from the best to the worst sector. The best, 3.53%. Okay, but that really should say utilities. Utilities was the best sector, not technology. I'll have to change that on the screen. Primarily because we saw a reduction in 10-year Treasury, and then the worst, energy at 34 basis points, but still in the green. Year to date, though, everybody, energy is still strong at 29.06% return. Staples bringing up the rear, but still in the green, 4.06%. Okay. Now, if we look at these markets, this past week we got the kickoff to earnings, right? Pretty much a big money center earnings week. We had JP Morgan, Goldman Sachs, Wells Fargo, B of A, Citi, a lot of big, all of them, all the banks just blowing out earnings. Okay. Analysts expect earnings this week, or for Q1 rather, to come in about 25% growth quarter over quarter. All right. Now remember, last quarter or last year, Q1 was, we had about half of the quarter was affected by COVID. And then Q2 is going to be even stronger. But we're just going to see some very, very strong growth this Q1 and Q2. And as long as interest rates stay under control, things should be fairly good. Now, if we look at the economic data, we got March retail sales that grew by almost 10%, 9.8%, the most since May, really. The most since, it's grown a lot. Jobless claims came in at 576,000, well below expectations. In fact, it's a new pandemic era low. We got consumer sentiment. Sentiment reached its highest level, 86.5 since the pandemic began. We also saw some important inflation data. We got consumer prices rising 60 basis points in March. And the core price, which is what the Feds look at for inflation, it was still up 30 basis points for the month. A little bit higher than consensus expectations. Import prices rose 1.2%, also above expectations as well. And then, of course, if we come over to U.S. Treasuries, even though we had huge blowout numbers in retail sales, CPI data up a lot, Treasury yields fell for the week. Right, 10-year declined back down to 1.57 from last week's high of 1.67. That's 10 basis point move lower. Okay, we also saw a little bit of a compression in credit spreads between between junk and investment grade. So that again is another reason why technology stocks really had a fairly good week as well. Okay. Now, of course, if we go across the pond and we go take a look at Europe, you can see European shares are doing very strong too. Let me just show you. Look at this. Across Europe, from the Euro stocks, the 50 largest companies across Europe, to the FTSE, CAC 40, the DAX, you know, that would be London, Paris, and Germany, some of the larger exchanges across Europe, all up for the week. Year to date, very, very strong. In fact, the Euro stocks, the CAC 40, the France index, and the DAX, both of them are higher than our Dow and S&P. The only one that's leading the way internationally is our Russell. Okay. Now, if you look over in the Asia Pacific area, you'll see the Nikkei and China both down for the week, and China's down year to date. I'll show you the charts and why they're down a little bit. Hang Seng, the Hong Kong index, is showing green all around. Okay, so that would kind of give us a little bit about what we've seen there. But we also saw in China, even though they're down, and you may wonder why, GDP this past week, Q1 GDP, first pass numbers came in 18.3% year over year. Keep in mind, Q1 of last year China was already in the thick of their pandemic. Okay, so they were at a very low base comparison in 2020. Although their retail sales beat consensus estimates as well. It came in at 33.9% increase. Expectation was 28%, but still very high. Industrial production came in at 14.1%. Exports rose 30.6% in March in US dollar terms, right? And keep in mind, exports is a key driver for growth for China in 2020. So you may be saying, well, gee, with all those extremely strong numbers with China, even in the US and Europe, strong numbers, why is China just doing so poorly? So what I want to do is let's just go take a look at the chart here. So what I'm gonna switch over. We'll start off with China here. Let me just find it on my screen, and then I'll switch the chart over, and I'll show you where China is year to date. So let me just switch this screen here for you guys. Let's just take you over here to the tracking index for China. And what you're going to see here with China is really interesting. You're going to see it is down year to date, around 18.6%, right? We're near the 2021 lows. You can barely see it, but right there is where we closed China on Friday. Now, after all of that strong numbers across Europe and the US and the China manufacturing ramping up big time, why is China underwater like this? Well, one of the bigger reasons is, and I don't see a lot in the newsprint on this, but one of the things that China, the government came out and said is they're going to start to probably withhold more stimulus, cut back a little bit. Markets didn't like that. Markets sold off and kept selling off. And now we're almost in a bear market in China. Can you believe it? Almost in a bear market. All because the Chinese government said we're going to cut back on stimulus. Now, China's playing the long game. Over here in Europe and the ECB, our politicians are just batshit fools. They're batshit crazy. They're just printing money left and right. Here, Europe, more so here than Europe, but still, just, we're going to just run our economy in the ground eventually. But right now, the markets love it, right? It's like giving chocolate to a 5-year-old kid. They eat one bar and they're going to want another. They're going to keep eating until they throw up. Well, China is really, I suspect they're hoarding gold because they want to try and make the yuan a bigger mainstream currency. They're going to have a long way to go, but that's their longer term objective. So they're really trying to shore up their economy, and they don't want to spend as much as we are here. They want a balanced budget. They want to do a lot of this, but it does have ramifications, and one of them is just a little bit of a cutback in the economy. Longer term, I think they're going to do very well, but short term, you can just see the aspect of what it does to the markets for the stock market. Okay. Now remember, I've told you guys over and over again that the stock market is not the economy, and the economy is not the stock market. Okay. And what we're seeing here, if we just take a look at the US markets, we're printing money left and right. You can see here on Friday, we made new all-time highs again, 41.8350. I told our members I had an initial near-term target of 4,000, and now I came out revised that to 41 to 4,300 for the year. And I said we could probably near-term hit 4250. And I've encouraged our members to stay long through this earnings cycle. Now, I do believe after our earnings cycle, which will probably come to an end around mid-May, we'll kind of dribble through. Next week, we got a ton of earnings coming out, big company names. On Monday, we get Coke and IBM, United Airlines. Tuesday, we get Lockheed Martin, Netflix, some of the railroads, Abbott Labs, a few others, Procter and Gamble, things like that. Wednesday, we're coming up with Chipotle and Discover, Baker Hughes, some of these others, Verizon. Thursday, we're getting American Airlines, AT&T, a few others there. And then Friday, we rounded out with American Express, Honeywell, and a few others. So the next 3 weeks is where the bulk of the earnings start. Last week was mostly just to kick off with big money center banks. But I suspect everybody's going to do like the big money center banks are going to come in very strong, and we're just going to run up. We're going to have a revision on a go-forward basis of our 2021 S&P earnings per share. Remember, the original estimate going into the year was anywhere from 160 to 185. One analyst was calling for this year we could actually hit an earnings per share of 200. And if we hit that, he's calling for the S&P to hit the end of the year at 4,500. Now, if the sun and the moon and the stars line up, vaccines start working, we start getting a lot of these other things, and interest rates stay relatively benign. And I've told our members that near term we could have a little bit of a spike, but I do believe I would agree with Jerome Power Ranger Boom Boom Powell in this case. I do believe near term higher inflation is more transitory. I went through my reasons several times in our weekly market watch with our members. And if you're not a member, I highly encourage you to come in because we're doing very well. Not just because the markets are up and a monkey could throw a dart at the stock listings and pick a winner, but we're trading it selectively but smart, right? As we shift from growth to value and then back to growth again, and then just trading some of the thematic ETFs as well. So you can see where the markets are just running up. But let's take a look at Asher, the Chinese stock. Or not the Chinese stock, but let's take a look at the other comparison I want to show you is let's look at the Fang Index. This is a customized index that I've made of Microsoft, Facebook, Apple, Netflix, Google, Amazon. All right. Now we're going to get the big tech probably in the next couple of weeks. This next week we get Netflix, but a couple of weeks later we're going to get Apple, Facebook, Amazon, Google, Microsoft, the big guys, right? And that's what this index is composed of. You can see here we're near all-time highs, but we haven't been making them consistently like the E-minis and the Dow. But you can see here it's up fairly strong, okay? Now I want to show you out of this, let's go take a look at the NASDAQ 100. That would be the 100 largest companies in NASDAQ. If we look at these NASDAQ futures, you can see here we did make a new all-time high Friday, right? 14,059.50. So it's running a little bit ahead of our big FANG stocks. So there's other stocks within the NASDAQ 100 that are doing good. There's no divergences on here. It's very strong, okay? But then let's take a look at the composite index, which is just everybody in NASDAQ. If we look at this, we haven't made a high since February of this year. We're coming back up, obviously, but the larger large cap and mega cap tech are the ones that are doing very well right now. When we shift back to growth, we're seeing the large and mega cap tech doing very well, and value stocks kind of lagging behind just a little bit. Now, if we look at the Russell, which is small cap and small cap growth, look at this. Our last all-time high was around the same. It was in March 15, almost a month ago, compared to the composite NASDAQ, which was 2 months ago, all-time high. So the Russell, even though it's maintaining this upsloping trend line, it's been over 4 weeks since we made all-time highs. So it's really not keeping up with some of the other stocks that I've been showing, primarily in the Dow and the S&P. So we're getting this return to mega and large cap tech, which would be growth, okay? And we're just seeing them just blast forward. And if we look at the VIX, look how the VIX has just slowly started coming down. Once we broke that 20 level, and by the way, this is the longest we held above the 20 in the VIX, going back a couple of decades, just really amazing. And now we're sliding back down. We've just been grinding lower. We're in what I call the yellow zone for option strategies, right? We're pretty soon going into the green zone, which is when we're going to want to look at contrarian plays, meaning we're going to look at being long volatility. Right here, it's you're kind of a Goldilocks scenario. You're getting higher premium still in option strategies, so you want to be playing that, but we're still subject to vol coming back in. Once we get down in the green zone, I think we're going to see some run-ups pretty quickly, and we're going to shift to some long Vega strategies, okay, long gamma strategies. So that's kind of what we're looking at on volatility. Now look at the bond market, okay. The bond market is running up, which is driving interest rates lower. Now remember what I said with bonds. Now if you're not a member, I had all of our members, and they may have missed, some of our members missed some of this initial move lower. But once we got down to this area down here, I said every time we run up and hit the 50 EMA, you want to be shorting bonds, okay? And it's just been, or just picking up puts and TLT because they go in the same direction. And then you can just see this rollover. Now we're making this run up to test the 50 EMA. If we can get up over about 159, maybe even 16, I'm going to be very interested in looking at shorting bonds again, or going long interest rates. But short term, it looks like the bond market wants to run up a little bit, i.e. interest rates want to come in a little bit. And if we look at the 10-year, look at it. We hit a peak in the 10-year back on the end of March. And then we've just been going down since. And just like bonds are approaching the 50 EMA from the bottom up, interest rates are approaching the 50 EMA from the top down. So I do believe that there's going to be a great time to go long interest rates or TBT or short bonds or TLT shortly, but not just yet. Let's let it run a little bit. I think we'll get a better price. Okay. And of course, if we come down and look at currencies, the US dollar has just been on a tear. Everybody was short the dollar. Like bonds, every time the dollar came up and hit the 50 EMA, it was short time. And you could short the dollar by going long the euro. It's what we called low-hanging fruit trade, right? Because the euro is about 58% of the dollar. And this is really not the dollar, it's the dollar index. So the dollar reacts to a basket of currencies. Okay, and wherever those currencies go, the dollar reacts in the opposite direction. Some of those currencies have a larger weighting, like an EFT, or an ETF rather. And you think I'm dyslexic, but some of the currencies have a larger weighting in the dollar than others. So, example, the euro is about 58% of the dollar index weighting. The yen is about 14%, a little under, and the pound is about 12%. So depending on where they go, and those three are the ones that drive the US dollar index the most. So if you want to short the dollar, then you look at probably going long the euro, right? So this is kind of where we're sitting. Now, everybody got short down here, but generally a little bit too late. You can see that we're back up. And I got to change this. I keep saying this every week. I'm going to do it right now and just get it out of the way. So that was the 2020 close. And let's just get that on there so it just doesn't confuse folks. So you can see we're in the green for the dollar year to date. Okay. We were very low in the dollar for 2020. But it's because it just sold off most of 2020, except for the pandemic. But now you can see we had this big run up. We actually broached the 200 EMA, and now we're coming back down. We broached this. So I think there's still one more run higher. Keep in mind, there is still a flight to safety when the markets crash. I don't think we're going to have a crash, but I do believe in the June, July timeframe, we got a 10% pullback coming. Okay. Members, I'll go into it in more detail with you, and I'll show you our target price for the S&P in May, June timeframe. Okay. So this is kind of what we're looking at for the US dollar. The euro is just the opposite. So you're going to see the euro a little bit stronger. Had that big move lower, just below the 200 EMA. It's moving up. It's broached the 50. I think this is going to roll back over. That'll be the final oomph in the euro. And then we're going to want to look at going long. Okay. The British pound. It's a hard trade, but I like right here being long the British pound. Okay. My target on the British pound is up here around 145. So I do like that move higher in the British pound. Foxtrot X-Ray Bravo right here, FXB would be the play. And you can do bull put spreads on this, or in the money bull call spreads, or out of the money bull call spreads, either way. But I do like this higher. It's a good trade, right? Members, we'll go in a little bit more detail on it. And then, of course, if we come down here and look at metals, look at gold, longer term, guys, I'm bullish gold. But look at what it finally did. We had a breakout in gold. Not only did we break the 50 EMA, but we broke out of the downsloping trend line. Now, we had another breakout before. It couldn't clear the prior pivot high. And there's no discernible prior pivot high here, other than there was a little bit of a peak right here, and then a peak here, and then a peak here. Okay. So I do believe, and we're in this overall resistance zone here. If we can get above it, then I think taking a long in gold would make some sense. We did have a bullish divergence fire off right here, okay, and it was what we call a solid bud, right? It was a bud fired off. Wasn't what we call our poor man bud. This was a normal bud, and it would have been a long signal. And I told our members we got long over here, and then we got long over here. And I said, once you get a little bit of profit, shut it down. So right here, stops would have been tightened. And now, are we going to repeat this pattern that we had here? Hard to tell. I mean, you just don't know. But you got to make the assumption that the pattern will repeat. If we can clear 1800, we're at 1773 right now, and get up over 1800 and then see that as a hold, I think it'll build a base to go higher. Silver, same thing. All right. Silver's been a little bit ahead of gold. You can see the downsloping trend line. Silver is ahead of gold. It's been over its 200 EMA longer. I think silver can run up a little bit higher as well. So these are ones worth a look. Oil, again, for our members, fade the move. And that was the trade. Holding the 50 EMA. I've got members in iron condors, unbalanced iron condors, unbalanced condors, and unbalanced flies here in the futures market. It makes sense. Okay. Nat gas, no trade right here, none at all. We like trading imbalances in the natural gas market. It's an easier, higher prob trade. All right. Okay, guys, that's where we're sitting for the week. For non-members, I'll see you next weekend for our next weekly roundup. If you're not a member, again, I encourage you to come and join us. Members, I'll see you tomorrow night for our weekly market watch. Have a good one, everybody.